Cadence Design Systems, what's it worth, where's it headed from here? Today we're going to be finding out in this video, so stick around until the end. And if you're not subscribed already, make sure you click that button so that you can find these cheap companies in the future and you can join us on the journey. The goal is 500 subscribers so that we can monetize the channel and also bring you guys some great things in the future. So if you want to watch that process, make sure to hit the subscribe button and let's get into it. So we have a price per share of $305.85. There's a price to earnings ratio of 80, a market cap of 83 billion, and an enterprise value of 83 billion. If you don't know what Cadence is, now's the time to pause the video and read the description here. So looking at the financial strength, there's a cash to debt ratio of 1.49. So for every dollar of debt, they have $1.49 to pay down their debts or expand their business. Looking at the profitability, I see versus the industry a lot of green bars, and versus history some green. But again here, gross margins 89, that's a seriously high amount of gross margins. Just about 90% of the revenues they generate. Operating margin 30.86, net margin 25.46, and free cash flow 30.48. So seriously strong margins here. We can see that versus history, they have just below their maximum for the last 10 years. And their minimum's only 85. So fairly small range here and sitting just below that maximum for their gross margins. For operating margins, they currently have 30.86, the highest in the last 10 years. For net margins, they're still above the median, but well below that maximum. And for free cash flow, they currently have 30.48, above the median, but below that maximum. I use these to tell me about the performance of the business, but I use ROE, ROA, ROIC, and ROC to tell me about the management strength. And for these, they look pretty strong as well, both versus the industry, and they're all teens or higher. So just about 20 or higher for these margins. No complaints. On their price to earnings ratio, their median in the last 10 years is 43, maximum of 84, and a current of 80. So maybe on the more expensive side of their historical performance. Looking at their annual financials, we can see that in 2012 they achieved $1.3 billion in revenue with 440 of net income, and currently they achieve $4 billion in revenue and $1 billion in net income. So about 1 to 4 here, that 25% margin. It looks like they had slightly higher margins, just about 1 to 3. So a slight margin decrease, but then again, the revenues are expanding. The revenues have expanded about 4 times what they were in 2012. So good signs there. Looking at it on a trailing 12-month basis, we can see fairly steady cash flows, net income solid. It looks like no deceleration. So pretty strong looking business model. When it comes to their cash to debt, they do have more cash than they have debts over most of their time frame here. We can see that it evened out here in 2022, but now they have more cash than they have debt, so no issues. And we see share buybacks, strong share buybacks, so increasing shareholder value by decreasing the share float. Another good signal. Their operating revenue by business segment is very diverse. 25.3% in digital integrated circuit, 25.3% in functional verification, 20.6% in custom integrated circuit, 11.2% in system design and analysis, 11.2% in intellectual property, and 6.3% in their services. By geographic region, they have 41.4% in the United States, 18.7% in other Asia, 16.6% in China, 16% in Europe, the Middle East, and Africa, 5% in Japan, and the remainder in other Americas. But to see what it's currently worth and where it could be headed, let's run a DCF. Before we do that, make sure you subscribe to the channel so that you can find these type of videos in the future, and you can help us get to 500 subscribers so I can bring you guys even better content in the future, and eventually get to the point where I can even share live picks with you guys so that you guys too can join on the journey and hopefully beat the S&P 500, because that's our goal. So in the DCF here, we see 4-star business predictability, so fairly predictable. That's another good sign. I do want my businesses to be predictable and having those revenues steady so that I don't have volatility in my portfolio. And we have data on the 10-year, 5-year, 3-year average for earnings per share as well as for free cash flow. So looking at earnings per share, we can see fair value with 20% priced in, far off. So let's find out what's currently priced in. So there's between 33 and 34% growth priced in for the next 10 years. In the last 10, they've achieved 25.5 on average. In the last 5, 21.2. In the last 3, 34. So it looks like it's pricing in their 3-year average for the next 10. So good amount of growth, but that's only for fair value. If they want to achieve even higher fair value, then they'll have to achieve higher than that. But realistically, 30% growth is a lot to be priced in for 10 years. So they could be trading for a premium based on their earnings per share. But looking at free cash flow and seeing what's currently priced in, there's about 31% priced in for free cash flow to equal a fair value of what it is today. And we can see in the last 10 years, they've achieved 18.7, 5 years, 19.4, and 3 years, 16.4. So nowhere near that 31.7. Again, indicating that it could be trading for a slight premium. So for the fair value to be even higher, they would have to achieve higher than that growth. And currently, if you think they're going to achieve what they have for the last 10 for the next, then we could see a fair value closer to 130, which is a significant downside or a higher premium, depending how you view the business. But in a business where the revenues are up and to the right like they were, you could end up paying for a higher premium, just like Costco. You know, if you're going to find one of those businesses where the revenues are up and to the right and it's trading for a discount, generally that's a great buy signal. But for me, it looks like earnings per share and free cash flow, the company is trading on both metrics at a slight or even marginal premium. So it doesn't exactly look cheap, but it does look like a high quality business, at least for the time being. That being said, this is my analysis for CDNS stock, Cadence Design Systems. If you have a comment or a question, or if you want to see a company analyzed, leave it down below in the chat. Make sure you leave a like and subscribe to the channel to watch as we progress and reach that 500 subscriber mark. And I'll see you next time.